The Hong Kong equity market, as measured by the Hang Seng Index, has fallen for 3 consecutive years since 2021. This was partially driven by the ongoing property crisis and below expectation economics and earning growth. At the beginning of 2021, the forward PE ratio was trading at 15 times. However, by March 2024, the PE ratio has dropped to a historical low of 8.1 times, over a 10-year low. But recently, the Hong Kong equity market has begun to caught the eye of international investors, with the Hang Seng Index rallying by over 20% after Chinese New Year. And there are 3 key reasons contributing to this significant rebound. First, the economic data has been better than expected. For example, Q1 real GDP growth was 5.3%, stronger than the consensus expectation. This makes the full-year target of 5% more achievable. Most economic indicators, such as PMI, export growth, and inflation, also look more healthy. Second, the government's national team has continued to support the equity market. According to Goldman Sachs' estimate, more than 200 billion RMB was deployed this year. To simply put, Chinese policymakers are underwriting a downside put option, which has helped the investor to price out tail risk and improve equity valuations. Thirdly, we have seen more pro-growth policies coming, including the 9-point guidance and supportive real estate policies. The improvement in fundamentals, combined with this policy, have all contributed to the recent rally. Interestingly, Hong Kong has outperformed China A shares in the recent rally, which is driven by valuations in our view. The AH premium, which measures the premium of China A shares over their Hong Kong listed counterparts, have reached over 155% at one point, the widest since 2008. This means the same company with the same earning is trading at a 155 premium in China A shares market compared to the Hong Kong listing counterpart. For international investors, investing in Hong Kong assets is also attractive due to the limited currency risk, as Hong Kong dollar is pegged to the US dollar, while the Chinese yuan has been depreciating against the US dollar. The rebound in Hong Kong equity market has caught the attentions of international investors, driven by improved economic fundamentals, government support, and favorable policies, as well as attractive valuations compared to the China A market. Hang Seng Tech Index rallied by over 20% since the end of January 2024 to April 2024, and there are 3 key reasons leading to the strong rebound of the internet sector. Firstly, we see some asset rotation from US tech stocks to Hong Kong tech stocks. US equity valuation is high, with Nasdaq 100 trading at around 27 times of forward PE ratio. In the meantime, Hang Seng Tech Index reached the lowest valuation since the index was launched in 2020. International investors start to rotate back to Hong Kong China internet stocks as a result. While the sentiment toward Hong Kong has been shifting more positive in the recent months, the root cause behind is also tied to fundamental. Sell-side analysts have been upgrading earning forecasts for internet companies. We see forward earnings have been improving gradually, including those big names such as Alibaba, Tencent, Meituan, Trip.com, and so on. The top holdings in the Hang Seng Tech Index are exactly the key beneficiaries. Since 2023, we observed the internet companies to undergo restructuring and refocus on profitable segments with high growth potentials, including gaming, advertising such as short videos, and e-commerce. On the other hand, we also see cost optimization exercise conducted in large internet companies. As a result, earning forecasts are upgraded, leading to outperformance in the recent months. Lastly, we've also observed that internet companies focused on increasing shareholders' returns through share buyback and increasing dividends. This is also consistent with the 9-point guidance released in April. And all of this aided the rebound in the Hang Seng Tech Index recently. Indeed, high dividend yields have been an outstanding factor in the Hong Kong equity market over most measuring periods. The Hang Seng High Dividend Yield Index, which invests into the top 50 highest yielding securities listed in Hong Kong, has demonstrated its resilience and outperformed the broad market Hang Seng Index consistently, including 1 year, 3 year, 5 year, and 10 years periods. This is because high dividend stocks tend to be more defensive in nature, as Hong Kong equity has been in a downturn in the recent years. The Hang Seng High Dividend Yield Index has maintained a dividend yield of around 7 to 9% for most of the last 3 years, meaningfully higher than the 3 to 4% dividend yield of the broader Hang Seng Index. This higher yield has been a key attraction for investors in a volatile market environment. The higher yield is particularly appealing for international investors, as Hong Kong does not levy any dividend withholding tax. Unlike most other developed markets, investors are seeking a steady income stream, and downside protections have gravitated towards these high dividend stocks, which provide the cushions against the broad market fluctuations. The reliable dividend income has made these stocks an appealing option for income-focused investors looking to participate in the Hong Kong market. Many of the high dividend stocks in the index are concentrated in the commodity-related sector. The high inflations and elevated commodity prices experienced in the recent years have boosted the companies in industries like energy and materials, which are mostly high dividend stocks as well. Another key reason for the outperformance of the high dividend strategy in the Hong Kong market is due to an initiative called Valuations with Chinese Characteristics. This is essentially a value enhancement program aimed at improving the valuations and profitability of Chinese state-owned enterprise. Similar initiatives have been rolled out in other Asian markets, such as Korea and Japan, and have proven to be successful so far. In the case of Hong Kong, the Valuations with Chinese Characteristics program has been a strong tailwind for high dividend stocks. The valuation gap between SOEs and privately owned enterprise in Hong Kong remain really wide. The forward PE ratio of the CSI Hong Kong POE index is trading at around 14.6 times, while the CSI Hong Kong SOE index is trading at just 5.7 times. Investors are optimistic that the valuations gap will continue to narrow as SOE re-rating initiatives progress. The horizons of these initiatives are expected to last for multiple years, if not a decade. China has likely rolled out this program to address the country's national pensions shortfall issue, as a massive size of pensions assets are invested in SOEs. By enhancing the valuations and profitability of these SOEs, the governments aim to mitigate the challenge posed by the aging populations and their pensions-related needs. As a result, this tailwind of SOE re-rating is anticipated to persist for a long period, providing a favorable environment for high dividend stocks in Hong Kong. Investors seeking stable income and potentially capital appreciation opportunities may find these dividend stocks an attractive options, especially given the defensive nature of high-yield stocks and the ongoing government support for SOEs. Overall, the combinations of the Valuations with Chinese Characteristics initiatives and the inherent resilience of high dividend stocks have been a key driver of the outperformance in the Hong Kong equity market in recent years. This trend is likely to continue, making this defensive, income-generating play a compelling investment proposition for those seeking exposure to the Hong Kong market. The launch of the Stock Connect program in 2014 and its subsequent expansion to include ETF in 2022 reflects China's continued efforts to open up its capital markets. Hong Kong's role as a superconnector has become even more crucial, serving as a bridge between Chinese investors and the global markets, as well as connecting global investors to China. When the ETF Connect was first introduced, the eligible product universe was relatively limited, with only a handful of ETFs available for southbound trading and a dozen for northbound. However, in the 2 years since its inception, the program has seen significant growth. Today, there are more than 10 ETFs eligible for southbound trading and over 100 for northbound. The southbound channel now includes ETF tracking the Hang Seng Tech Index and the Hang Seng High Dividend Yield Index, providing Chinese investors with exposure to Hong Kong dynamic technology sector and high-yielding stocks. The market response to this Connect initiatives have been overwhelmingly positive. For example, the ETF Connect has seen robust trading activity, with northbound average traded value exceeding 2 billion per month, and the southbound average surpassing 6 billion per month. This strong participations from investors on both sides of the Connect program underscore its acceptance and popularity. In April 2024, the Hong Kong Stock Exchange announced the further expansion to the scope of the ETF Connect program. First, the minimum asset size requirement has been reduced to around 1/3 relative to the previous threshold, making it more accessible for a broader range of ETFs. Secondly, the eligibility requirement for southbound trading has been relaxed, allowing ETFs with as little as 60% exposure to Hong Kong equities to be included, enabling Chinese onshore investors to gain access to international equity exposure through ETF Connect. These developments are a clear indications of Chinese continued commitment to financial integration and opening up its capital markets. As the ETF Connect continues to gain traction in the coming years, it is expected to play an increasingly important role in facilitating cross-border investment flows and strengthening the positions of Hong Kong as a global financial hub and a key gateway to China's market. The trend of growing institutional adoptions of ETF is not limited to Korea, it's also evident in the Hong Kong market. Traditionally, ETFs has been perceived as primarily as a retail investment vehicle, given their small minimum investment sizes and ease of trading. However, this perception is rapidly evolving as institutional investors increasingly recognize the benefits of using ETFs in their portfolios. One key factor driving the increased institutional adoptions of ETFs is their cost efficiency and transparency. Compared to actively managed funds, ETFs offer a more cost-effective means for institutions to gain broad market exposure. Additionally, the transparent natures of ETF with their underlying holdings and real-time pricing appeals to institutional investors seeking clarity in their investments. Another significant advantage of ETFs is their intraday investability. This feature become extremely helpful during highly volatile market conditions, especially during March 2020 at the onset of COVID outbreak. Unlike mutual funds, which can only be traded at the end of each day, ETFs can be actively traded throughout the day, allowing institutional investors to respond more swiftly to market developments. The growing institutional adoptions of ETFs in Hong Kong is also evident, from notable inflows to Globalix Hong Kong. For instance, over the past 3 months, the firm has received 7 million inflow into its broad-based Chinese equity ETF, primarily from a local pension provider. This demonstrates that ETFs are gaining traction amongst institutional investors, such as pension funds, as they seek efficient and transparent investment solutions. Furthermore, the increased ETF flows into Chinese-focused products illustrate that investors are rotating back to the China market. In fact, when analyzing the geographic regions with the highest ETF flows globally, China is only second to the United States. Year to date, the net inflows into China ETFs have accumulated to around 50 billion, represent around 15% of growth of the existing asset, which is a really high growth figure. Korean investors have traditionally maintained a heavy concentration in the domestic equity market, which is largely dominated by a handful of large-cap names. As investors seek to diversify their portfolio, looking beyond their home market and exploring international opportunities can be a prudent strategy. One market that might hold particular appeal for a Korean investor is Hong Kong. The Hong Kong equity market presents an attractive alternative, especially those who are seeking exposure to stocks with lower valuations compared to the domestic Korean market. By diversifying into the Hong Kong market, Korean investors can potentially benefit from a broader range of investment opportunities. However, the decisions to invest into overseas market should be made with a long-term perspective in mind. Successful investing often requires patience and a willingness to stay the course, particularly when navigating unfamiliar and more volatile markets. By adopting a long-term approach, investors can increase the likelihood of achieving their investment objective and weathering short-term market fluctuations. Within the Hong Kong equity market, the high dividend space is likely to remain particularly attractive to investors. This is driven by several factors, including the ongoing re-rating initiatives for state-owned enterprise and the wide valuation gap between SOE and private-owned enterprise. As SOE undergo its re-rating process, high-dividend stocks are expected to benefit from a strong tailwind. By diversifying their portfolios to Hong Kong equities, particularly those with a focus on high-dividend stocks, Korean investors can potentially access attractive investment opportunities while benefit from the unique characteristics of the Hong Kong market. However, it's essential for investors to maintain a long-term perspective and carefully evaluate the risks and potential rewards associated with any international strategy.